Today, we are taking a deep dive into Waaree Energies, a really pivotal name in India's green energy space. We're going to break down how the company is making a huge strategic shift, moving from just being a domestic module assembler to a truly integrated global player. And, maybe more importantly, why the market seems to be sleeping on this massive transformation. So, right off the bat, we're looking at a pretty clear contradiction. You look at Waaree's fundamentals, and they are just surging. I mean, net profit growth hit an incredible 116% in the third quarter. But then you look at the stock price, and it's been heading down. This gap between how the company's doing and how the market feels about it, well, that's the central puzzle we're here to solve. And that really brings us to the core question, right? Why is there such a massive disconnect between the company's triple-digit growth and the market's, well, pretty cautious reaction? To figure that out, we've got to look at this from both sides, the bull case and the bear case.
First up, let's talk about the bull case. We're going to focus on the company's fundamental strength and the really significant strategic moves that have been fueling its recent growth.
This slide really captures what Waaree calls its strategic bridge. It's all about their evolution away from the up and down world of cyclical manufacturing and its volatile margins. The company is pivoting hard towards an integrated model. They're focusing on owning assets, which brings in recurring revenue, and offering complete system solutions. This isn't just a small tweak, it's a fundamental shift in their entire business model. So, the first pillar of this new strategy is all about vertical integration. By commissioning a massive 5.4 gigawatt solar cell plant, Waaree is taking control of a super critical part of its value chain. This move to make key components in-house is designed to do two things: capture more value from every single unit they sell, and, this is crucial, protect the company from volatile cell pricing on the open market. It's all about defending those profit margins. The second pillar is what you could call the U.S. export engine. Waaree is being really aggressive here, expanding into the high-margin U.S. market. They're targeting 5 gigawatts of capacity by 2027. And the strategy is smart. Not only are they increasing sales into a premium market, but by manufacturing locally, they're looking to bypass potential import tariffs. And that brings us to the third pillar, Waaree's evolution into a systems provider and an independent power producer, or IPP. By setting up an inverter facility and creating new subsidiaries to actually own the power-generating assets, Waaree is moving way beyond just manufacturing. This shift creates a stable, recurring revenue base, which is a huge de-risking move away from the cyclical nature of just selling products. So has this strategy actually paid off? Well, you just have to look at the numbers. The results are, frankly, compelling. A 116% year-over-year jump in net profit, 118% revenue growth, and a really strong EBITDA margin hanging around 25.5%. You can see this performance is structurally driven by bigger scale and being able to pass costs through effectively. Now here's a key competitive advantage, especially when interest rates are high: Waaree's fortress balance sheet. With a debt-to-equity ratio of just 0.10x, which is incredibly low, the company has the financial firepower to fund its big capex plans and its U.S. expansion. That's a luxury that its more indebted competitors just might not have. All right, so the bull case is undeniably strong, but to get the whole picture, we have to flip the coin and look at the bear case. This is what's going to help us understand the market's hesitation and the reason for that falling red line we saw at the beginning. The main risks here really fall into two buckets: regulatory and market. The regulatory headwinds include potential headaches with U.S. customs and Indian tax authorities. On the market side, you've always got the threat of pricing pressure. That recent 36% correction from the stock's 2025 highs, that's a direct result of investor anxiety around these very issues. And to put a number on this regulatory risk, the company has made a provision of nearly 295 crores. That is a significant amount of money set aside specifically to cover potential liabilities from these U.S. customs and Indian tax matters. It's exactly this kind of uncertainty that has been weighing down the stock. So we're left with this clear split, aren't we? You've got exceptional growth on one side and these tangible regulatory risks on the other. Let's try to bring these two cases together and figure out what the key deciding factor is for the company moving forward. If you look at the company's strategic roadmap, it's pretty clear. The immediate priority is all about execution, getting that new cell facility ramped up. In the near term, the focus is going to shift to diversification, using their Australian subsidiary in IPB Ventures. But honestly, it's the medium-term goal for 2027 that really holds the most weight for investors. When you boil it all down, the key deciding factor for Waaree's valuation really hinges on one thing: the successful execution of its U.S. expansion. Hitting that 5-gigawatt manufacturing capacity target by 2027 will be the definitive proof point for the market. It will confirm whether this powerful bull case can finally overcome the current headwinds. So, in conclusion, Waaree Energies has really grown up. It's moved from its startup phase into what you'd call an institutional-grade asset. Its strategy, combining vertical integration, a strong balance sheet, and that key access to the U.S. market, positions it for potential market dominance. For investors, this current period of stock consolidation offers a chance to watch a leader in the middle of a major strategic change. The big question, of course, remains, can they execute?